Ladies and gentlemen, thank you for standing by, and welcome to the Jacobs Fiscal First Quarter 2021 Earnings Conference Call and Webcast. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star one on your telephone. If you require any further assistance, please press star zero. I would now like to hand the conference over to your speaker today, Jonathan Doros, Investor Relations. Thank you. Please go ahead.
Thank you. During this presentation, we'll be referring to certain non-GAAP financial measures. Please refer to slide 2 of the presentation for more information on these figures. In addition, during the presentation, we will discuss comparisons of current results to prior periods on a pro forma basis. See slide 2 for more information on the calculation of these pro forma metrics. For pro forma comparisons, current and prior periods include the results of the Wood Nuclear business, which closed in March 2020, and Buffalo Group, which closed in November of 2020. We have provided historical pro forma results in the appendix of the investor presentation. Turn to the agenda on slide 3. Speaking on today's call will be Jacobs Chair and CEO, Steve Demetriou, President and Chief Operating Officer, Bob Pragada, and President and Chief Financial Officer, Kevin Berryman. Steve will begin by updating the progress we are making against our strategy and reviewing our commitments to ESG and sustainability solutions. Bob will then review our performance by line of business, and Kevin will provide some more in-depth discussion of our financial metrics, followed by an update on our Focus 2023 integration efforts, as well as a review of our balance sheet and cash flow. Finally, Steve will provide a detail on our updated outlook along with some closing remarks, and then we'll open the call for your questions. With that, I'll now pass it over to Steve Demetriou, Chair and CEO.
Thanks, John. And thanks everyone for joining us today to discuss our first quarter fiscal year 2021 business performance and strategy update. It's been about a year since the pandemic started, and we hope everyone is safe and healthy as COVID-19 continues to impact all facets of our daily lives. At Jacobs, in addition to keeping our people safe, we're continuing to support national governments and industry in their production and distribution of critical vaccines. Turning to slide 4 to discuss our first quarter results, it's important to review our strategy, which is foundational to an investment in Jacobs. We believe the transformation that Jacobs has undergone over the last several years has created a compelling, multi-decade investment opportunity for our current and potential shareholders based on 3 key tenets. First, we have transformed our culture, aligned around a common purpose of creating a connected, sustainable world, underpinned by strong values of we do things right, we challenge the accepted, we aim higher, and we live inclusion. This culture permeates through our more than 50,000 people, the solutions we deliver for our clients, and the engagement in our communities where we live and work. Our purpose-driven culture has also enabled us to quickly adapt to changes in market conditions, while also staying focused on our long-term vision of being a technology-enabled solutions provider. Second, we have a portfolio of solutions aligned to a diverse set of global opportunities, such as space exploration, cyber readiness, climate change, and modernizing and digitizing our infrastructure. Our thematic growth areas are global, allowing us to address them efficiently, effectively, and competitively at scale through our integrated global platform of technology, our talented resources, domain expertise, and enhanced brand awareness. Finally, our Jacobs management team has demonstrated the ability to strategically allocate capital, including successfully executing acquisitions. Our continued focus on strategy and execution has resulted in a strong start to fiscal 2021, even while continuing to manage the headwinds from the global pandemic. First quarter net revenue increased 3% year over year, and adjusted EBITDA grew 8%. Our backlog ended the first quarter up 11% year over year and up 7% on a pro forma basis. Given the strong momentum, we're increasing the midpoint of our full fiscal year 2021 adjusted EBITDA and EPS outlook. Our cash flow generation was strong during the first quarter, and our balance sheet remains healthy. In the near term, we do expect to deploy excess cash toward paying down debt. Last quarter, we announced a strategic majority investment in PA Consulting, and we are happy to share that the transaction was overwhelmingly approved on February 4th, with 99.8% of PA shareholders voting in favor of the transaction. Particularly exciting was the fact that the voluntary election for management rollover was fully subscribed, and new partner hiring has also been very successful post-announcement, indicating the enthusiasm and commitment of PA partners and employees about the future growth opportunity of this partnership. Confirmation of the scheme of arrangement is awaiting regulatory approval by the Financial Conduct Authority in the UK, and we expect to close the investment by the end of this current quarter. PA's performance for calendar 2020 exceeded our expectations, and their pipeline of strategic and technical consulting work continues to grow. This includes a new engagement with the UK's Department of International Trade, advising on Project Defend and UK supply chain resilience to underpin economic and national security, along with reaching a key milestone with the National Institute for Health Research, where they completed a UK public sector first delivery of Google Cloud Search to upgrade research platforms. Once we complete the transaction, we expect significant benefit for the clients of our firms, driven by the complementary solutions offering of PA and Jacobs. Now, looking further into fiscal 2021 and beyond, we believe Jacobs has a compelling organic growth opportunity. And as appropriate, we will further accelerate that growth through thoughtful strategic acquisitions that offer a higher return versus our alternative of repurchasing shares of Jacobs. Turning to slide 5, I'd like to review some recent ESG actions. As a company, we're committed to delivering results to all our stakeholders, our employees, our clients, our investors, and our communities. Delivering on this includes our commitment to our sustainability strategy, called Plan Beyond, and our climate action plan launched last year. I'm pleased to report that we achieved a net zero carbon, including 100% renewable energy for our operations in 2020, and our carbon reduction targets have been formally approved by the Science Based Targets initiative. The climate agenda will continue to be front and center in 2021, with the United States rejoining the Paris Agreement and the 26th UN Climate Change Conference of the Parties, or COP26, being held in November. In support, Jacobs announced our Pledge to Action, a campaign inviting our clients and suppliers around the globe to take measurable actions to tackle climate change before the opening of COP26. And we are also leveraging the power of our Jacobs people in making a positive impact. We launched our Climate Countdown Challenge, where employees can join a new mission each month to tackle the climate crisis. Through both of these initiatives, we hope to raise awareness, inspire, and motivate individuals and companies, and demonstrate the collective power of organizations taking actions now to make an impact for generations to come. Moving to slide 6. At Jacobs, we intend to lead from the front in the transformation to a net zero economy. In combination with the COVID-19 pandemic, climate change remains the major global driver for ecological, social, and economic disruption, impacting every person, community, business, and governments around the world. It's also a major disruptor, advancing technology-enabled innovation and sustainable business models for addressing decarbonization, the global energy transition, and resource scarcity. Jacobs is uniquely positioned to support our clients and communities in developing and deploying solutions and technologies across the full spectrum of decarbonization efforts, including renewable energy and clean power, carbon capture and storage, energy efficiency and energy storage, green buildings, sustainable transport, circular economy, carbon management, mitigation, and compliance consulting, as well as adaptation and resilience for all facets of infrastructure. This includes developing technology solutions like our recently announced launch of Jacobs Travel Service Optimization Solution, which transforms the home-to-school travel experience for special educational needs and disabilities children and young people. This solution combines our deep domain knowledge with the latest advances in data analytics to determine the most efficient ride-sharing experience while supporting decarbonization and our long-term transition to a net zero economy. With that, I'll turn the call over to Bob Pragada to provide more detail by line of business.
Thank you, Steve. And now moving on to slide 7 to review the quarterly performance for Critical Mission Solutions. During the first quarter, our CMS business continued its strong performance despite the continued high levels of COVID-19 cases. Our workforce and clients have addressed the primary challenges of physical distancing and continue to execute on our contracts, regardless of work location, at approximately 95% of normal operating levels. Total CMS backlog is at $9.7 billion, representing a 14% year-over-year growth and up 4% on a pro forma basis. The CMS strategy is focused on both revenue growth and margin expansion by aligning to our go-to-market strategy towards critical national priorities of digital modernization, strategic data utilization, low Earth orbit satellites, hypersonics, and cyber. I'll discuss each in greater detail. Beginning with digital modernization trends. Our global government clients face the current task of transforming their digital stack of information, communications, and security systems in order to maintain their national security. We are on this transformation journey with our clients as we develop and operate their next-generation digital systems. In December, we cleared the protest period on the Navy's Kings Bay Intelligent Asset Management Award, and we were awarded another new digital modernization project for the Army's Intelligence and Security Command. In addition to digital modernization, a second key growth driver for our business is the DoD's increased focus on strategic data utilization. The DoD is becoming a data-centric organization combining edge computing with data intelligence and analysis at hyperspeed and scale. Data is considered a strategic asset similar to the priority given to weapon systems, and it is increasingly central to warfighter advantage in and out of theater. As an example, our intelligence, surveillance, and reconnaissance team was recently awarded a seat on the 10-year, $950 million ceiling IDQ to provide various unmanned aircraft solutions and satellite payload services for the Air Force's Advanced Battlefield Management System. ABMS allows a joint force to use cutting-edge methods and technologies to rapidly collect, analyze, and share intelligence information and make decisions in real time. Moving on to low Earth orbit satellites. These satellites play a key role in advanced communications, military reconnaissance, intelligence, and other imaging applications. Jacobs began a new era in advanced space radar payloads with the successful launch of its Mango 1 satellite. Our approach enables government and commercial customers to proliferate space-based sensors that see in the dark and through clouds to provide near continuous monitoring, gathering valuable, actionable intelligence in the ground, sea, air, and space domains. And now on to hypersonics. Hypersonic offensive and defensive weapons technology is unquestionably one of the highest priorities for our government clients. Jacobs, through its decades of supporting the Air Force and NASA, is a clear leader in hypersonic solutions. During the quarter, CMS was awarded a hypersonic test cell contract from the Air Force at Arnold Engineering Development Complex to transform the facility into a unique, large-scale, clean air, variable Mach number test facility with extended runtime capability. A final trend is to discuss cyber. The recent SolarWinds Sunburst Advanced Persistent attack continues to make headlines, giving it sophistication and dwelling time. In fact, the Biden administration has requested a $9 billion plus increase in spending for cyber and modernization. And, as mentioned on our call last quarter, the British government also approved its largest military investment increase in 30 years by £16.5 billion, or 10% per year over the next 4 years in defense areas, including cybersecurity. CMS's cyber and intelligence business has grown over the past several years to more than 3,300 professionals today. Part of our growth strategy is to continue to add adjacent capabilities and customers. The Buffalo Group acquisition, which closed in November, posted strong initial performance and is a catalyst for achieving immediate scale and deep client access with a strong majority of the U.S. intelligence agencies and combatant commands. In summary, we continue to see strong structural demands for our solutions. Supporting this, the CMS sales pipeline remains robust, with the next 18-month qualified new business pipeline remaining above $30 billion, including over $10 billion in source selection and an increasing margin profile. Now on to slide 8. I'll discuss our People and Places Solutions business. Last quarter, we conveyed optimism around our balanced portfolio and our ability to remain resilient through economic and geopolitical volatility. This is demonstrated by strong P&L performance in the quarter, as well as 9% year-over-year backlog growth. After a steady pipeline in 2020 and momentum in government funding strategies, timing remains uncertain in our focus geographies, such as in the U.S. and U.K. We anticipate further improvement to our pipeline as governments solidify their budgets. I'll discuss 4 trends impacting the macroeconomic environment and our sectors, all of which we are well positioned to capitalize on. First, climate change and decarbonization of the economy, driving sustainability and resilience for public and private entities. Second, economic stimulus for long-term job growth and economic relief. Third, the pandemic and continued growth in health, life sciences, and cloud computing. And fourth, modernization of infrastructure and the digitization of the industry. Beginning with climate change and the decarbonization of the economy. The environmental sector is experiencing growth as governments, the investment community, companies, and citizens confirm their commitments to climate action, act on their decarbonization agenda, and increase focus on PFAS and emerging contaminants. We generated the largest growth in this sector year over year and anticipate our investment in PA consulting to further strengthen our decarbonization solutions offering. These solutions, such as advising our clients on their climate action goals, developing strategy and policy, assisting in program implementation, and providing intelligent asset management, are embedded in all our geographies and sectors. A great example of this is our recent win in Orange County, Florida, to develop innovative, resilient, and sustainable waste management systems to reduce greenhouse gas emissions from operations for cleaner electricity use. Recent awards for the Marinus Link electricity interconnector, linking the states of Victoria and Tasmania in Australia, and a project to connect one of the world's largest lithium-ion batteries, are key elements supporting Australia's renewable energy transition. In the Middle East, where we are the program manager to Expo 2020 Dubai, the Sustainability Pavilion, known as Terra, premieres this month. Leveraging our industry-leading sustainability expertise, Terra is designed to be a net zero carbon driving during full operations and provides a glimpse of what is to come when Expo fully opens later this year. Next, I'll discuss economic stimulus spend aimed at long-term job growth and economic relief. In the U.S., the current administration is pursuing an aggressive agenda that aligns directly with the long-term growth of our markets. We have every reason to believe that focus will continue as the administration and Congress address COVID relief, climate change, environmental justice, resilience, and the need to create long-term job growth and economic recovery through infrastructure modernization. As activity on these issues progress, we anticipate funding to support our clients' projects at the federal, state, and local level, which we are uniquely positioned to support through long-term historical framework agreements. In the UK, we are well positioned for stimulus and a leveling up agenda to rebalance the economy across the country, and are supporting our clients with smart integrated solutions with tangible social, environmental, and economic benefits for the communities they serve. In our Asia-Pacific geography, particularly in India, Singapore, and Australia, we expect an infrastructure-led economic revival around transportation and green recovery, largely centered on large-scale renewables and energy to catalyze the economy over the coming year. Moving to the impact of the pandemic and continued growth in health, life sciences, and the cloud computing supply chain. COVID vaccine production is progressing to increase capacity and distribution, as well as increased demand from contract manufacturing companies with an acute focus on biotechnology. And we expect our investment in PA consulting to strengthen our end-to-end delivery in this sector. Demand for cloud computing continues to drive our data center business globally. We remain agile and are diversifying our client base to adjust to market trends in semiconductor manufacturing. Building on established relationships and industry-leading leadership, we are in the negotiations for several new life sciences and electronics projects. In the built environment sector, we are gaining momentum with our clients focused on the global healthcare crisis. We were selected to lead the programming and initial engineering efforts for a new campus for the University of California Davis Health Center, as well as the Royal Prince Alfred Hospital redevelopment in Australia, where investment in technology and physical infrastructure support new trends in virtual care. Finally, I'll talk about modernization of infrastructure and the digitization of the industry. Infrastructure modernization remains a priority investment across all sectors and geographies. Transportation continues with a heavy focus on highways and rail. We were awarded the engineering services project for the Houston Metro Intercity Bus Rapid Transit System, as well as the new rapid transit project in Southeast Asia that will enable the workforce to adapt public transport, representing another example of how we support our clients with solutions that improve sustainability of our cities and places. Water sector trends are steady, with implementation of digital technologies and a focus on the water energy nexus and resiliency. Using Replica, Jacobs' proprietary digital twin platform, we developed a digital twin of the watershed for Las Virgenes Municipal Water District in California for the evaluation of water supply scenarios while balancing water quality and operational resilience. In summary, the foundation of our P&P business remains strong, with our long-term client base and frameworks in place to move rapidly when government funding is solidified. Positioned extremely well for the near-term secular trends, we expect a steady growth trajectory with profitability improving as we continue to move higher on the value chain. I will now turn the call over to Kevin to discuss our financial performance in more detail.
Thanks, Bob. And now turning over to slide 9. First quarter gross revenue increased 1% year over year, with pro forma net revenue flat. Revenue for CMS increased 3% on a pro forma basis, and P&PS net revenue was down 3%. The P&PS decline was mainly attributed to slower revenue burn, although the outlook for the business remains strong, with backlog up 9% year over year. In the near term, we expect reported net revenue growth to be flat to up slightly year over year, then gain additional momentum in the second half of fiscal 2021. Adjusted gross margin in the quarter as a percentage of net revenue was 23.1%, down 110 basis points year over year. The lower gross margin on a year-over-year basis was driven primarily by two factors: a tough compare from Q1 2020 that benefited from a favorable impact from lower benefit costs carried in corporate, and a higher mix of CMS revenue, which carries lower gross margins but also has a lower G&A as a percentage of revenue. CMS gross margins increased on a year-over-year basis by almost 100 basis points as we benefited from a mix of higher margin revenue from acquisitions and new business wins. P&PS gross margin saw some modest pressure in Q1 due to a higher amount of America's program management and O&M revenue. Lower consolidated G&A as a percentage of net revenue of 170 basis points year over year to 13.6% more than offset the gross margin impact. As it pertains to G&A, the first quarter continued to benefit from our ability to proactively manage our cost structure. The CMS mix benefit previously stated, and some focused 2023 savings from lower real estate costs, lower travel, and lower COVID-related employee medical costs. As we look forward, we will continue to be disciplined in the management of our G&A cost. GAAP operating profit was $214 million and included $22 million of restructuring, transaction, and other charges, the majority associated with our recently announced Focus 2023 initiative, and $23 million of amortization from acquired intangibles. Adjusting for these items, adjusted operating profit was $259 million, up 10%, with both lines of business posting double-digit % increases in operating profit. As a result, our adjusted operating profit to net revenue was 9.5%, up 60 basis points year over year on a reported basis. GAAP net earnings and EPS from continuing operations were $257 million and $1.96 per share, and included a benefit of 54 cents driven by mark-to-market adjustments for our Worley equity stake, a 47-cent benefit related to a mark-to-market investment in AI software provider C3 AI, 16 cents per share of after-tax charges primarily related to Focus 2023 and other restructuring costs, a 17-cent charge related to the impairment of our AWE management investment, and amortization of acquired intangibles of 13 cents. Excluding these items, second quarter adjusted EPS was $1.41, up 17%. Let me provide some detail on our investment in AI software provider C3.ai. In 2010, we made a small investment in the company, which recently completed an IPO. Today, our investment represents more than 750,000 shares in the company. Due to our lockup requirements surrounding our ownership, we applied a discount to the quarter-end value of our interest in the company, resulting in the investment valued at $85 million on our quarter-end balance sheet. At today's price, our interest represents a greater than 20 times return on our original investment. Q1 adjusted EBITDA was $280 million and was up 8% year over year, reaching 10.3% of net revenue. Finally, turning to our bookings during the quarter, our pro forma book-to-bill ratio was 1.2 times for Q1, driven by strong book-to-bill in P&PS. From a pipeline standpoint, we continue to grow the CMS pipeline, both on a pro forma and reported basis. The timing of when this robust CMS pipeline will convert into backlog is weighted more toward the second half of fiscal 2021, resulting in our projected backlog exhibiting year-over-year growth for the year. The P&PS overall sales pipeline has increased as well, driven by a pro-environmental Biden administration, broader potential infrastructure stimulus in the U.S., and an improving economic outlook. The exact timing of when many of these new stimulus-related opportunities will convert to bookings will become clear over the coming months and will help support backlog growth for the year. Regarding our LOB performance, let's turn to slide 10. Starting with CMS, revenue was up 9.5% year over year and up 3% on a pro forma basis. CMS operating profit was $110 million, up 22%, and up 15% year over year on a pro forma basis. Operating profit margin was up 90 basis points year over year to 8.5%. The improvement was driven by our strategy to focus on higher margin opportunities, such as our recent NORAD win, which is now fully ramped. We also saw some additional benefit from favorable project closeouts. As we progress through fiscal 2021, we expect low single-digit CMS reported revenue growth as we approach the one-year anniversary of the Wood Nuclear acquisition and continue to ramp new wins. More than offsetting the revenue headwind from fully transitioning off two large, lower-margin projects previously discussed, which account for a nearly $600 million headwind in annual revenue in 2021. Given the strategy to capture higher value businesses via both acquisitions and organic efforts, we continue to expect reported and pro forma operating profit growth to be up double-digit year over year. Moving to P&PS, Q1 net revenue was down 3% year over year, driven by a lower short-term burn rate as bookings growth remained strong and backlog was up 9% year over year with a 1.3 times book-to-bill. We continue to see solid revenue growth in our Americas business, offset by some timing-related slowdown in our advanced facilities and the Europe and Middle East businesses. P&PS operating profit was up 10% year over year, and as a percentage of net revenue was 13.7% for the quarter, up 160 basis points year over year, driven by disciplined management of G&A costs. Looking forward, we continue to project P&PS revenue to be up low single digits for fiscal 2021, with improving year-over-year growth as we progress through the year. We expect operating profit margin as a percentage of net revenue to moderate from Q1 levels, but still increase from fiscal 2020, driven by strong operating profit growth. Our non-allocated corporate costs were $47 million for the quarter. While this figure was supported by strong cost discipline, we continue to expect our non-allocated corporate costs to be higher year over year, driven primarily by inflation in medical costs, enhanced employee benefits, and increases in discretionary medical procedures that were put on hold during fiscal 2020 and the first quarter of 2021 due to COVID-19 concerns. Now turning to slide 11. I'd like to update you on our Focus 2023 and M&A integrations. We continue to make strong progress on our strategic initiative, Focus 2023, that we believe will, one, lead to enhanced employee and customer experience, two, improve our ability to capture emerging high-growth margin opportunities, and three, drive a more efficient cost structure through increased automation and process alignment for overall longer-term profitability. During the quarter, we incurred an additional $10 million charge and cash outflows of approximately $30 million related to our Focus 2023 initiative. These investments were mainly related to improving the utilization of our physical spaces, deploying new tools and technology for better efficiency in our business, and strategically leaning out the organization. Turning to our recent acquisition of the Backlog Group, the company had a strong quarter with double-digit revenue growth. We continue to expect that the acquisition will deliver 8 to 10 cents adjusted EPS accretion during fiscal 2021. Regarding PA Consulting, we are pleased with the preliminary results for calendar year 2020, which are tracking ahead of our expectations. We are also optimistic about their calendar year 2021 growth plan, and after the transaction closes later this quarter, we look forward to discussing their results and growth plan in more detail. We continue to expect 52 to 57 cents of adjusted EPS accretion from PA Consulting for fiscal 2022. And finally, when including all integration and restructuring initiatives, as well as the AWE charge, but excluding PA Consulting, we now expect a total of approximately $100 million of P&L charges and $110 million in related cash outflows in fiscal 2021. When including an additional non-recurring headwind associated with the payment of 2020 related UK VAT tax payments in the current quarter, we expect a total of approximately $150 million of one-time cash outflows in fiscal year 2021. We will update these estimates to include PA Consulting after we close the transaction. Now on to cash generation and the balance sheet on slide 12. During the first quarter, we generated $96 million in reported free cash flow, a significant improvement versus the level seen in the last several Q1 periods, primarily a result of an improvement of 3 days in DSO versus a year ago, other working capital benefits, and less headwinds from cash restructuring. The strong Q1 cash flow included a net negative of $44 million of one-time costs associated with Focus 2020 restructuring and other items. Regarding the balance sheet, we ended the quarter with cash of approximately $837 million and a gross debt of $1.8 billion, resulting in $1 billion of net debt before attributing the benefit of the Worley and C3AI equity. Treating the Worley and C3AI equity as cash, our pro forma net debt to expected adjusted 2021 EBITDA is approximately 0.4 times, a clear indication of the strength of our balance sheet. During our current fiscal second quarter, we finalized a new delayed draw term loan related to our PA Consulting investment. Post PA close, we expect our balance sheet to have continued financial flexibility. However, we will be prudent to deploy excess cash toward debt repayment over the short term. And finally, given our strong balance sheet and free cash flow, we remain committed to our quarterly dividend, which was increased 11% earlier this year to 21 cents per share. Now I'll turn it back over to Steve for slide number 13.
Thanks, Kevin. Now let me review our total company outlook for fiscal 2021. Given our strong start to the fiscal year, we're raising the low end of our previous guidance ranges. We now expect adjusted EBITDA outlook to be a range of $1.075 billion to $1.155 billion versus our previous outlooks of $1.055 billion to $1.155 billion. And we expect adjusted EPS to now be in a range of $5.30 to $6 versus our previous outlook of $5.20 to $6. It is important to note that our guidance does not include any benefit from the PA Consulting investment, which we expect to close by the end of fiscal second quarter. Looking beyond fiscal 2021, we continue to expect double-digit adjusted EBITDA growth as we benefit from our Focus 2023 initiative, as well as potential infrastructure-related stimulus and our strong alignment to a diverse set of large secular growth opportunities. Operator will now open the call for questions.
As a reminder, ladies and gentlemen, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. In the interest of time, please limit yourself to 1 question. If you have follow-up questions, please press star 1 again to rejoin the queue. Our first question comes from Joseph DeNardi with Stifel. Your line is now open.
Oh, thanks. Good morning. Bob, you talked a little bit about the Mango launch. Can you just speak to kind of what that now allows you to do in order to maybe more effectively market and sell that capability? And then can you just update us on the pipeline of opportunities related to that technology across the government to the extent you can?
Sure, Joe. So on the first, yeah, we're really excited about what Mango 1 brings to us. So it's a heavy payload, low Earth orbit satellite that's ours, and we invested in this, and it's now in space gathering data. It is kind of a right of entry to some of the higher end, both intelligence agencies as well as other application platforms, and it's gonna put us in a really unique position for some of the not only ongoing pursuits, but even for offerings that come in the future. So I'd say that, you know, the programs and projects that we've talked about, Project M and all kinds of other tropical fruits that we refer to these programs by, it puts us in a very much differentiated position to further strengthen our win ratio. There's only a few that have this.
Our next question comes from Jamie Cook with Credit Suisse. Your line is now open.
Hi, good morning, a nice quarter. I guess my first question, relates to the strong margin performance that you saw in PP&S. So I'm just wondering, how much of that is sort of project mix versus potential, short-term lower discretionary costs, how sustainable that is. And then I guess my longer-term question is, while the margins in CMS are improving, there's still a big gap between CMS and P&PS. I'm just wondering, over what time can the gap between the two segment margins narrow more? Thank you.
So, Steve, you want me to take that?
Yeah, go ahead, Kevin.
Yeah, look, Jamie, thanks for the question. First thing is on the P&PS margin profile, we actually saw a good solid gross margin performance, but really the fundamental margin profile driven primarily by the very disciplined management of our G&A costs. Of course, some of that has been driven already by some of the work that we did when we announced some of the activities relative to our reduction in footprint on real estate, some of the travel reductions that we've been doing. But there's also been a fairly significant proactive actions taken in terms of managing our labor costs appropriately relative to the current situation regarding the pandemic. We're closely monitoring that, and as we think about how our business starts to come back, which is fully anticipated over the course of this year, some of those costs will come back into play as it relates to the business. But that's going to be associated with higher gross profit as well. So ultimately, margin profile will continue to be robust. Maybe not at the same level as Q1, but certainly well above what we would have expected to see in 2020, what we did see in 2020. So feeling very good about that opportunity. In terms of the margin profile between the two businesses, we've said that we believe actually margin profile can improve on both sides with both of the businesses. And consequently, a big focus in 2021 is starting to reduce in a more tangible way the margin profile difference between the two businesses. And we've been communicating that CMS margins should be strong improvement this year. And I think we started to see that in the first quarter, and we would expect that to continue to play out over the balance of 2021.
Our next question comes from Josh Sullivan with The Benchmark Company. Your line is now open.
Hey, good morning.
Morning.
Hey, Josh.
Just a question on the free cash generation, and congratulations on moving the needle there. Just to the comments before about, kind of the mix shift moving around. I mean, is there anything we should be thinking about? You've done well on the DSOs. I mean, is there anything that we should be thinking about as far as the free cash flow profile, while you do that mix shift up to kind of more high value work?
In general, I would say that the opportunity for us to continue to drive DSO improvements from existing levels, we believe remains an opportunity. It's tough work, as I've always said, relative to the ability to continue to drive that number down. Very pleased with the work in Q4 of last year. Very pleased with where we ended Q1 of fiscal 2021, and we believe that there's an opportunity to continue to drive that down, and that our mix of projects won't necessarily ultimately result in that underlying trend longer term. So we still feel good about that. Still got a lot of work to do, but we feel good about the cash flow generative nature of the portfolio going forward.
Our next question comes from Jerry Revich with Goldman Sachs. Your line is now open.
Yes, hi. Good morning, everyone.
Morning.
Steve, I'm wondering if you could talk about your M&A pipeline as it stands today, considering the cost reduction efforts and, the upcoming integration with PA Consulting. How active are you folks in terms of scouting for opportunities at this point? And, based on the lean work that you're doing, does that expand the opportunity set in terms of the cost reduction opportunities you might have as you look at the next set of companies in the pipeline, whether it's, 21, 22 event? Can you just flesh it out for us, please? Thanks.
Right. So, we are a company that is always active in making sure we're exploring all opportunities globally, and we're going to continue to do that. We have recently, executed on some acquisitions, with the Buffalo Group and PA Consulting most recently, and Wood Nuclear is fairly new. So for us, our top priority is to execute on those recent acquisitions and demonstrate continued success. We feel proud of what we achieved with the major one of CH2M back in 2017, and have successfully executed and exceeded expectations. And so we want to focus on that right now. As I mentioned in my remarks, over the next months, our primary capital deployment is going to be to pay down debt. However, when we look at the pipeline of opportunities in our strategy, there are several bolt-on opportunities, even within PA Consulting. When we think about what we have initiated there, with coming together with PA, they've been a very successful firm in doing bolt-on acquisitions that's helped them create value, and we want to continue to support that. And together, we think that there's going to be some real interesting things that we can do in that whole consulting arena, which is higher margin, higher value business. And then, of course, anything that we can do to just accelerate our digital modernization, strategic data utilization, as we have done, with the series of cyber acquisitions, including most recently PW and the Buffalo Group. And so we'll continue to be active on the government services space and any other bolt-on acquisitions that can strengthen our P&PS business as well. And, the final thing I'll say is there's some geographic expansion opportunities. When you look at our mix of business, it really is still majority, the majority of our revenue comes from the U.S. and UK, and then it drops down significantly from there. And so we think there's some great geographic expansion initiatives over the coming years.
Our next question comes from Andy Kaplowitz with Citigroup. Your line is now open.
Hey, good morning, guys.
Morning, Andy.
And just trying to get a read on P&PS, given the lower revenue burn but strong backlog. Bob, you talked about still seeing some funding and COVID-related uncertainty out there, but the trends you mentioned, especially more focused on climate change, digitization, stimulus, seem to be overwhelming that uncertainty, at least in backlog. So maybe you give us more color. What was the biggest driver of backlog growth in Q1? And especially if we do see some U.S. stimulus here, is it possible the backlog growth continues at that high single-digit rate you saw, or even accelerates from here?
Yeah, so maybe Andy, I'll address that first and then go back to the year-on-year performance. We do. So the short answer is yes. The pipeline that we capitalized on in Q1 the dialogue in anticipation of stimulus continues with our clients. And so where we sit in that value chain, where we would be in the initial concept work, scoping, looking at what potential optionalities are around end objectives of these infrastructure projects, I see those continuing, as well as the opportunities we're seeing were driven by the pandemic, but in the healthcare and in the data center and semiconductor manufacturing world. So I think those remain strong. As far as what we see coming out of the funding, the year-on-year piece, I'd really kind of point to the sustainability of our work due to the framework and the positioning we have with our clients. So yes, there has been a bit of